Today, I'm going to discuss about how to do cash flow analysis for any investment property. How do you find out if the property is negative geared, neutral, or positive geared? And we're also going to discuss about what is the difference between gross rental yield and net rental yield. Me and my team has developed a tool on the Excel which is very easy to understand and use. I'm going to use the same tool to explain all about the cash flow analysis. So if you tune with the video till the end, I have something for you. Please look into this disclaimer before we go ahead. Hi everyone, my name is Dinesh Goyal and I'm here from Property for Financial Freedom. We provide one-on-one mentorship to buy properties in the growth area where data stacks. We also execute as a buyer agent to secure those great properties. Let's jump into the cash flow tool now. So this particular tool which you can see on the screen is the one me and my team has put together to do cash flow analysis for our clients to just find out if the property which we are going to buy is neutral geared, negative geared or positive geared. So today I'm going to discuss about the real property I just purchased for my clients, and we are going to find out if that property is positive geared or what is the cash flow analysis on that property. So this tool is very easy to understand, and whatever the yellow box you can see in this sheet, you can just put your own numbers for that. Let me zoom a little bit so that you can see that better. So first you have to start with the purchase price. So for example, you're buying a property, you estimated, okay, this is the price value you're gonna put in, so you have to put that purchase price there. This particular property which I bought, I know a lot of all of the comparables of that properties are going 530k plus, so I have put a market value as 530k for that property. This market value is more about forecasting the growth and everything. It's not about the cash flow analysis. So very first thing is you'll find out how much deposit total capital you need to secure that property. To get that, first you have to put LVR. So LVR is loan value ratio. That means, if you have 10% deposit, that means you are on a 90% LVR. If you put 20% deposit, that means you are going to be on 80% LVR. In general, banks doesn't charge you lender's mortgage insurance LMI if you are 80% or below LVR. In this particular case, my client works for bank, and bank give them a offer that if you get the investment property, you just need to have to pay 10% and you don't have to pay any LMI. So in that particular case, I am not putting any LMI here, but in general, if you buy a 500k property, you pay $5,000 to $6,000 LMI depending on the lender. So I'm putting 90% here. That brings 10% deposit here. The next is property manager's inspection. How we are securing properties remotely in different locations are because we have very good team and property managers on the ground which help us secure those great properties. In this case, as I'm taking everything like property management costs on myself, so we are keeping it blank. But for you, if you spend like $500 on inspections, they generally charge you somewhere around $70 to $100. If you get done like 5 inspections, you have to consider, okay, I spent $500 for property management inspections. So in this case, I'm putting 0. Next is building and pest inspection cost. Basically, we do not negotiate on building and pest inspection clause in our contract, and that costs you somewhere around $500 to $700 to cover both building and pest. In Perth, we generally paying, so we have a very good building and pest inspector who do very good report. We generally pay $670 to them, so I'll put 670 here. Next is legal fees. That includes your conveyancer's fees and, for example, PEXA fees and all of the government charges. And you have to also pay for whatever the rates are outstanding. What does that mean is, for example, previous owner has paid rates from 1st of July to 30th of June next year. So you're buying mid of the year. So whatever rates the client has already paid for the coming time, you have to pay that on a settlement. So if you include all of these things, you might be coming with the figure of 3,000, 3,500 here. So I put 3,500 here. With stamp duty, I put 15,000 lump sum number, but I will provide a link in this tool where you can just go and find out, okay, what is the purchase price and what stamp duty exactly you're gonna pay. So whatever the stamp duty there, you have to put that in here. Yeah. Next is depreciation schedule. So this is something that is done by the quantity surveyors. Whenever you secure the property is settled before the end of the financial year, it is recommended to get that done. Yeah, if you're buying a good like 2000 plus houses, you get kind of a handsome amount of depreciation. How it is calculated, that depreciation is like for 40 years. For example, you bought 2000 built property, most likely you can claim the depreciation till 2040 for that property. And it is one of course, once you get it done, they will give you next 10-20 years, whatever the life of the building left, they give you the depreciation schedule and you claim every year. So that costs you somewhere around $400 to $800, depending on if the quantity surveyor has to do the inspection on the property or is there enough data online to create the depreciation schedule. Yeah, so I put $500. I think my client hasn't done that, but I'm just putting $500 here. So to secure this 517K property, my client was looking for somewhere around $71,000 to $72,000 deposit. Yeah, if you go high LVR, for example, you go 80%, where you don't pay any LMI, so your deposit may be $123,000. I'm going back to the 90%. Yeah. So this particular client is getting 5.5% interest rate. So I have put that 5.5% here, but it can be different for you, less or more. In this market, it is changing every time. You can put like additional 0.5% in your calculation and see, okay, if the interest rate increases to that much, how much that gonna cost to my pocket. Yeah. So for now, I'm putting 5.5. Next is property management fees. This basically uh, in Perth, generally it's a bit higher. It depending on the state to state. What's the management fees? In Victoria, you may find it cheaper. In Perth, it was very expensive, but now it is very competitive, getting coming down. So we have very good property manager which charge you around 9% over there. So it is very competitive. So I'm using that 9% property management fees here. Next, for doing the post-tax calculation, you have to put what is your tax rate, right? What is the maximum threshold tax rate you have? You have to put that number in. Next is vacancy rate. For example, in areas where we are buying is 0% vacancy rate. What does that mean is the property there's no vacant property in the area, and generally we get the clause to protect us to put the property on market before settlement. In most of the cases, we get the tenants just before the settlement, yeah, and we move them in as soon as the settlement has done. So in most of the cases, we have very very less vacancy. I'm putting 1% here for our calculation, but you can go 2%, 3%, 0%, wherever you are comfortable with. Yeah. Next is this property, 317K properties is achieving 650 rent per week. Yeah? So this is total rent you are getting. It is just multiplied by 52 number of weeks in the year. So basically this is the total rent coming to you. Yeah, let's go through the expenses now. Very first expenses is insurance. There are two types of insurances. One is landlord, one is building, right? Roughly you'll pay $500 for landlord insurance in Perth and around $1,300 for this size, this bit of house kind of, I think client is paying $1,300 for this one. So the total insurance cost is $1,800. Next is rates. I've put in numbers like a council rates to be $2,200 and water rates as $800. So you have the $3,000 as rates. Property management rate. So basically, that is a one-off cost when you are if the property is vacant and you are advertising the property, and the initial lease fees is generally 1 week of whatever the rent is. So I keep it 650, and whatever the advertisement fees is, you put that in there. So, but see, this I am considering it every year, but this is one of cost because your tenant may stay there for 3 or 4 years, so you don't have to pay that again and again. Yeah. So total property management fees, this management fees here coming from whatever the rent you get into the management fees. So this is total management fees. So now your property management comes to $3,942 here. Yeah. So again, here we have considered $1,500 as maintenance as well. In some year you might not get any maintenance issues, or some years you pay 2,000, 3,000. So to just average it out, I have put $1,500 in repairs and maintenance. Wherever you are comfortable, you can increase that number too. Yeah. So this is next, interest payments. Whenever you do cash flow analysis, you just have to consider interest payment. Whatever capital you are paying, if you're going like, not only like you're paying principal with interest. So principal is always you're paying loan. This is not you have to calculate in your cash flow analysis. In general, we go with the interest only payments, which is very easy, and the property is more easy to keep. There's a good cash flow analysis in the property, and there's a lot of benefit on tax side if you go interest only payments as well. So that's my general recommendation, but it's really up to your choice. In this case, the client is doing the interest payments only, so it is $25,000 592 roughly. It is the multiplier of whatever the loan amount is. Yeah. So this is $25,000. Now the total estimated expenses are 35,834, which is looks like a bit more than what your rent is. Yeah. That's why now we have pre-tax going out of the pocket, like $46. The last thing I missed is like non-cash expense, which is depreciation. This is something which is not costing you anything, because you have that depreciation schedule done. You can claim certain amount of the depreciation. For this property, this is very nice big house. Generally you get around $6,000 depreciation. It's 2005 built house, and you get $6,000 depreciation for this kind of house. Yeah. So see, this is all the expenses, this is the income. So if you talk about pre-tax, this property is negative geared, right? So it's harming you $46 every week, and you say monthly and annually harming you $2,372. But this is very first year. With the time your rent increases, and that pre-taxes can also convert into the positive very soon. Yeah. So for example, my own property was rented for 330. Within 1.5 years, it is now rented for $500. It is currently 475, but the new lease is signed for 500. Yeah. So in hot markets where we are buying, you can expect rent growing very fast with the purchase, with the property value as well. But that particular very first year, this property is costing you $46 from the pocket. But after all the depreciation, benefits, and whatever the interest you are interest and expenses you are claiming against the property becomes positive. So this property in today's scenario is positive as well. So now, what is difference between gross yield and net yield? Gross yield is basically whatever your rent is into 52 divided by the purchase price. You can also consider the vacancy rate. So this is generally this formula, this divided by this. Yeah. But I have considered vacancy rate here as well. If you put 0 here, so your vacancy rate will become 6.5%. Yeah, so this is generally let me go 1%. Yeah, so this is 6.47%. It's very very good gross sale property. So net yield is basically after all the expenses and getting the tax benefit is this tells you if the property is positive cash flow, negative, or neutral. There's a lot of different definitions, right? The net yield, this is what my understanding is, but you have to do your due diligence on that as well. So basically so this one is whatever ins, whatever outs plus depreciation, right? Divided by the purchase price of the property. In this particular scenario, this property shows it is a positive cash flow property with a net yield of 0.77%. If this net yield is in the negative, that means the property is negative here. If it's zero, that means it's neutral. Yeah. So this property gives you exactly if the property is harming your pocket or not. Yeah, so next part which I want to so we are still working on that, but I can a little bit explain on that part as well. So this is the cash flow analysis forecast. What we do here is how your properties, what is the projected capital growth. If it's 7%, generally in Australia the property grows for 7%. So to be conservative, you have to use 7%, and you can find okay after how many number of years your property value is growing. And what is your net yield? See, net yield is growing with the time because rent increases, and your gross yield is increasing as well. Yeah, post-tax cash flow, and you do see all these good graphs. That is more we do for our clients. Generally this is the very first thing we do. Then we do all these forecasts and we run our numbers as well. Okay, the very first year the property market value is 530, year one it grows like 6-7%. This is the new next value, so that gives you all these numbers as well. We don't, this is purely for clients. We do deep numbers on that for each and every client. Yeah, so this was all about the cash flow analysis tool. Thank you everyone for watching this video. As promised in the beginning of the video, what I'm going to share is this Excel sheet, the cash flow analysis tool, to do your own due diligence and you to find out if your new purchase is neutral, negative, or positive. In return, I'm just asking you to subscribe my YouTube channel and like my Facebook page. If you just subscribe my YouTube channel, just comment on that saying yes, subscribed. Just share your details, or I'll reach out to you to get your details, and I'll share that Excel sheet in your inbox. That will help me to grow this network and will help me to deliver more educational stuff in the future. Thank you very much once again, and see you in the next video. Take care.